Following accounts receivable on our balance sheet, we might see something called a note receivable. So let's talk about exactly what is a note receivable. This is a written promise to pay a specified amount of money, and we usually charge interest on this, either on demand or at some future date. What you see in front of you is called a promissory note. The amount is referred to as the principal, and this is the amount, principal, or sometimes we might call it the face amount. This is the amount that will be repaid plus the interest amount. You'll see the date of the note, how many days. This one is a stated future date. So this person, Julia Brown, the maker of the note, is promising to pay $1,000 to Techcom Company in 90 days. And it specifies the interest rate of 12% and where the note is payable at. How do we compute the maturity of the note? So we were just told that was a 90-day note. It was issued on July 10th. We know there are 31 days in July. It was issued on the 10th, so we have 21 days remaining. Add in the 31 days for August, 30 days for September, and we're now at uh, 82 days. So we know that the note matures on October 8th to get us to the 90-day time period. How do we calculate interest on a note? We take the principal of the note, the $1,000, times the interest rate. Interest rates are usually quoted annually, so it will be an annual interest rate, times the number of days. In this case, it was 90, divided by 360. I'm going to allow you to use this. It's called the banker's rule. They use 360 instead of 365 for easier computations. And on this particular note, we get an interest amount of $30. How do we record that notes receivable? So in this case, Julia Brown received this note at the time of the sale. So they gave her 90 days to pay, and they issued a promissory note. Has a little bit more priority in debt collection than just a trade accounts receivable. So we debit the notes receivable for $1,000 and we credit sales for $1,000. What happens if we take a note in acceptance of a past due accounts receivable? Here we have Techcom agreeing to accept $230 in cash along with a $600 60-day 15% note from J. Cook to settle her past due account. So we record the cash that we received for $232, and then we debit notes receivable for the $600 note, and we credit her full balance for $832. Next, we're going to talk about how we record the honoring and dishonoring of a note and adjustments for interest. So when a note is honored, that means in the last example, J. Cook had 60 days to pay us, and she did. She paid us on December 4th. So we credit the notes receivable for the principal amount, the $600. We know how much the interest is, so we do $600 times 15% times 60 over 360, and that is $15. So the cash that we receive is $615. So she honored the note, she made the promise to pay, and she did so. What happens if the note is dishonored? We have a promissory note, but it is not paid on the due date of December 4th. In this instance, we do the same thing that we did back here. We credit notes receivable, we credit interest revenue, but we put the full amount back in the accounts receivable for the customer, in this case, J. Cook. If our notes receivable falls between accounting year ends, we will do an adjustment for the interest amount. So in this case, we have December 16th, Techcom accepting a $3,000 60-day 12% note. So there aren't 60 days from December 16th to the end of our accounting period on December 31st. So we have to figure out the interest from December 16th to December 31st and record that as interest receivable. Here you'll see a $3,000 note times 12% interest times 15 days, December 31st minus December 16th, divided by 360 equals the $15. In the following year, when the amount is paid, we'll have our notes receivable credit for the $3,000, and then we have the remaining number of days that it is paid. So we'll take the $3,000 times 12% times 60 over 360. We know our total interest is $60, and so we also know that we accrued $15 at the end of the year. We have interest receivable of $15. So $15 is credited to interest receivable. That means that by default, the interest revenue for this period for the remaining number of days, I guess it would be, if it was 15 there, it would be 45 here, is $45. Okay, we're going to walk through some notes receivable transactions on exercise 712 and exercise 713. Please open your practice set now. Let's walk through exercises 712 and 713. They are both on the same tab, as you'll notice. In this one, we are going to take a look at recording these notes receivable transactions. On December 13th, Danica Company, I think I omitted the name of the company, accepted a $9,500 45-day 8% note from Miranda Lee for payment on her account. So we are going to record this as note receivable. That will be a debit for $9,500, and we will credit the accounts receivable. Notice that the year end is December 31st, and the note will not be paid by that time. So we need to accrue the interest. So we are going to say interest receivable and interest revenue. The dollar amount that we accrue is going to be the $9,500 times 0.08 times 18 days. December 13th to December 31st is 18 days, divided by the 360-day banker rule year. So I'll go over here and I'm going to do that in my Excel worksheet. Times, oops, not divide, let's multiply, times 18 divided by 360. There we go, we've got $38. And I'm just going to reference that same cell for my revenue because I know it needs to be the same. That's all that we do for the exercise 712 in the year 2018. 2019 rolls around, and on the 27th, we receive the payment of principal and interest on the note dated December 13th. And if you look at 18 plus 27 equals 45 days. So she paid on time on the exact date that it is due. So here we are going to say that we know we received some cash. We know we have to write off the notes receivable because we collected it. So that will be now zeroed out. Well, the note receivable was $9,500. We know that we collected the interest that we accrued up here. So that interest receivable will be $38. I really want to do that today. And then we also know that we'll have additional interest revenue from the time from January 1st to January 27th. But what we can do is we know the amount of cash that we should have collected. We should have collected $9,500, right? 9,500 times 0.08 times 45 divided by 360. $9,500 face value, 8%, 45 days, 360 days in a year. So we know that should be $95. We already had $38 in the year before, so I know that this plus the 9,000, right? I also received that, plus the 9,500. Sorry about that. Equals the amount of cash that I received. So now I know that my interest revenue for the remaining period is what is left over. $57. On the 3rd, we accepted a $5,000 10% 90-day note for Thomas Company. Okay, so same kind of thing, note receivable. Thomas, amount is $5,000. I jumped ahead a little bit here and we recorded the entries for the 3rd and the 17th. We took notes receivable for the accounts receivable balances. On April 16th, Chang dishonored the note when presented for payment. So what we do there is we put it back in the accounts receivable for Chang. So that amount is going to be $2,000 plus the accrued interest. So we'll take it away from the note receivable. The note receivable was $2,000. Interest on this note should have been, let's see, we should have had on the Chang note 2,000 times 0.09 times 30 divided by 360, $15. So we put that total amount, the 2,000 plus the 15, in Chang's receivable. On the 1st, we now discover that we don't think Chang is going to pay us at all, so we write that off against the allowance for doubtful accounts. So now we're going to debit allowance for doubtful accounts. We're going to debit that for the full amount, 2015, and we're going to credit accounts receivable Chang. On the 1st of June, we received the payment from Thomas of principal and interest on the note dated March 3rd. So paid on time. So here we're going to, we know again that we have cash, we have interest revenue, and we have the notes receivable for Thomas. And that amount is the 5,000. Interest revenue is going to be the 5,000 times, what was that one? 10% times 90 divided by 360. So $125, and cash that we received then is the sum of the two of those. Okay, hopefully you have a little better understanding of the note receivable, why we might take them, and how we calculate the interest, etc. on them. The next lesson will be our final lesson for this module.